Hi, everybody. It's Brent Johnson here from Santiago Capital in San Francisco, and I have the pleasure today of speaking with Lyn Alden of Lyn Alden Investment Strategy. I first came across Lyn, I think either late last year or earlier this year on Twitter, and she always does a great job of putting out fantastic charts and graphs and really some data-driven arguments when she's trying to make her points, and I find her to be extremely smart. I don't necessarily agree with her on everything, but it's always interesting to talk to people that have a different point of view than you. And so I'm really looking forward to talking to you today, Lyn.
Yeah, thanks for having me. And I've enjoyed our back and forth a lot. And it's been a pretty volatile period for the dollar, and yet it ultimately remains range bound. And it's been kind of fun having a back and forth.
Well, I think that's really the interesting thing is if you look at the dollar. I mean, there's a lot of dollar bears out there. There's also, some dollar bulls, and I've been pretty vocal about why I think it's going higher. There's been a number of people who have been vocal about why they think it's going lower. But the reality is it's the same place it was 5 years ago. It's had some breakdowns along the way, and it's had some runs higher along the way. But essentially, it's kind of just flat. But I think, one of the things that you've been known for is you've changed your opinion on the dollar a little bit. You're not necessarily a dollar bear or a dollar bull. I think short term you're a dollar bear. I don't want to put words in your mouth, but that's my impression, and we can talk about that a little bit. But what I know that in the past you've been bullish the dollar, and then I know some things happened last year that made you short term bearish. So I think it'll be fun to kind of talk through some of the things that have happened over the last year, and also maybe some of the things we see coming down the pike over the next few years, and we'll just kind of talk about it back and forth.
Sure, sounds good. Yeah, my approach over the past couple of years is I publish an annual report that focuses on global equity markets, including their currencies. And for example, in 2018 and early 2019, I ranked the dollar as about neutral, and I was more bearish on the euro. So overall, I had a more bullish view on the dollar and the yen compared to the euro. And we've seen that play out pretty well. But around the time of the repo spike in September 2019, and then specifically in early October, I kind of shifted more dollar bearish because we went from a tightening monetary policy in the U.S. to a more loosening monetary policy. And specifically in rate of change terms, we shifted from having among the tightest monetary policy in the world. We were rising interest rates. We were as you described it, sucking up global liquidity. But then we started to get some fractures in that. We started to get interest rate cuts, and then it kind of culminated in that repo spike where we had to shift from quantitative tightening to quantitative easing. So since then, I've been, somewhat more structurally bearish on the dollar, but my position changes a little bit depending on kind of multi-month moves. Like, is the balance sheet increasing? Or are they trying to taper? Things like that. They can kind of, affect the speed of that.
Got it. And coming into this year, the consensus trade by far was, be long EM and be short the dollar. And that lasted for about 3 weeks, and it completely reversed, and the dollar started running higher. EMs kind of broke down. Equity started to break down. And then March came, and we had the big, dollar squeeze, for lack of a better word. And that's kind of, we have a difference of opinion there. I know of why assets were getting sold, but the bottom line is they were getting sold. But since then, the Fed and the other central banks have come in, flushed the market with liquidity. And going back to the rate of change, I think you're right. The Fed has been more aggressive than the other central banks, although I would argue on a few different measures, they're still behind the curve. But to your point, the rate of change has been in the Fed's favor, and as a result, the dollar's pulled back from that jump it had. So I guess one of the questions I have for you is, let's say between now and the election, what do you foresee, and do you think that the Fed stays aggressively on top of the dollar, or do you think we get a rebound here sometime in Q3?
I think we've been oversold a little bit in the near term, so I wouldn't be surprised to see somewhat of a bounce. I think a lot of it might come down to whether or not they can agree on a fiscal bill later this summer, because they are trying to taper some of their monetary support, at least in the Treasury market. But of course, recently we had the announcement of their willingness to buy individual corporate bonds, so that kind of countered that a little bit. So we'll see kind of in rate of change terms how their balance sheet is stacking up to their peers. But in addition to that monetary side, we have some of the fiscal potentially tapering, right? So we could see an end to the extra unemployment benefits, the initial impact from the helicopter checks everyone got, the $1,200 checks that, is wearing off at this point. So it'll be interesting to see later this summer if, Congress and the president can pass anything, because if they don't, we could see another deflationary crunch. We could see another solvency event, or they could pass something and kind of keep the party going through the election. And it'd be interesting to see how that works out. I think that's going to be a big determinant for the dollar.
Yeah, I think it's really interesting because it's getting, everybody says the Fed is independent and central banks are independent and they should be free from political pressures. And I've always kind of thought that was incorrect, for lack of a better word. It's a nice thing to say. In reality, I don't think it's the case, but I do think it's an interesting thing right now, because after everything that the Fed has done, if we do get another deflationary move and, like a move down in asset prices or markets, and the Fed doesn't react and they quote unquote let it go down, that could almost be seen as being political to hurt Trump. And so I think it'll be really interesting to see, how the central banks act over the next 3 to 4 months as we kind of run up into the heat of the election. I have a hard time seeing the Democrats, giving Trump what he wants as far as a fiscal stimulus bill in Q3. But at the same time, they're kind of in a tough spot too, because if, we get a second wave of COVID, or if, we continue to have unemployed workers, that could be painted by, Trump or the Republican side as, playing politics as well. So I think it's really interesting between now and the election. I would say I won't be shocked at all if we continue to have range bound between now and the election. I don't think that the dollar is going to break down significantly, but I can't rule it out either. But I don't think we're going to have a huge move to the upside either. Probably stay in this 95 to 99 range that we've had for the last 3 or 4 years. But one thing I want to make sure that we touch on before we go too much further is in March, when we kind of had the big move up in the dollar and the sell off in assets. I would say that was caused because of a dollar squeeze. So my first question to you is, do you agree that there was a dollar shortage in March, and that's kind of what led to the sell-off in assets?
Yeah, I agree, because, as you point out, there's more than 12 trillion in U.S. denominated debt overseas, and they primarily get that the dollars to service that debt through trade. So when we had a large trade shutdown, we had a lot of them were cut off access from dollars. Oil prices went down, so they had trouble making dollars. And so we saw, a rapid sell-off in risk assets, and then it even spilled over into the treasury market. So foreigners sold $300 billion worth of treasuries in March and April to get dollars.
So I think we both agree on that. So we both agree that there was a shortage. We both agree that they were selling U.S. denominated assets in order to get the dollars to meet that dollar squeeze or margin calls, however you want to term that. I think where we maybe disagree is who initiated the idea of extending the swap lines so they wouldn't have to sell their dollar-based assets. I think you have put out some work stating that I don't want to put words in your mouth, but it's my impression that you think that it was initiated by the Fed so that they would stop selling treasuries in order for the treasury market to remain functioning correctly, for lack of a better word. And it was not initiated by the other countries asking for the swap lines. Do you want to tell me how you feel on that, and then we can kind of discuss it back and forth?
In my view, I don't focus heavily on who initiated it. It's about who has the incentive to do it. And so my view, a lot of people focus on that the Fed was kind of, providing like a good-natured handout or bailout to some of their peers, whereas my view is more two-directional, right? Because the foreign markets didn't want a big liquidity crunch in their markets, and they can't print dollars. But on the same side, the Federal Reserve didn't want to see just massive selling of risk assets and then even treasuries. And if you look at their press releases and their meeting minutes, they repeatedly cited the dysfunction in the treasury market. So we had wide bid-ask spreads, we had very poor liquidity, and they cited heavy selling pressures, especially on the longer end of the curve, for a lot of their decisions, including the international repo they offered. They said, instead of selling them on the open market, they can loan them to us for dollars. And then they also, when we had that big brief spike in yields because there were so many foreigners selling and even, risk parity funds and other domestic sources selling, the Federal Reserve ramped up their QE to $75 billion a day at the peak to, try to become the primary buyer. And they actually ended up accumulating more treasuries, the Fed, in March and April than the entire foreign sector had accumulated in the past 6 years, just in those 2 months.
Yeah, and I think that kind of goes back to the rate of change thing that you were talking about earlier. And so interesting that I actually agree with you. I think it's a two-way thing. The U.S. definitely does not want interest rates spiking. That's pretty clear. Where I think that I disagree with a number of people, and I don't know if I could disagree with you on this or not, is that despite the fact that treasuries the yields were increasing, it wasn't just treasuries yields that were increasing. If you look around the world, treasury prices from a number of sovereigns were spiking. And, I think the treasury wanted all markets, not just the U.S. Treasury, but I think all the treasuries and all the central banks wanted all markets to calm down and get out of this liquidity crisis, for lack of a better word. So I think it is a little bit of a two-way street. I think I think for the people who were arguing that the Fed had to do this in order so that the U.S. government wouldn't go bankrupt, I think it's a little. I think it's a stretch. Now, I know a lot of people don't agree with me, but I think it's a stretch because I think if the U.S. government goes bankrupt, then France is going bankrupt, Thailand's going bankrupt, Australia is going bankrupt, China's going bankrupt. I don't think that there's any scenario under which treasury yields spike and foreign yields fall. I'm curious what you think about that.
I think it certainly could happen, but it's not my base case. I think probably going forward over the next several years, any monetary sovereign, so any country that has the power of their own printing press, or it's a trickier case in Europe because they kind of combine their printing presses. But any of these monetary sovereign regions, I think a lot of them are going to try to lock yields below the inflation rate. So that's what they did. That's what the U.S., for example, did back in the 1940s, which was the only other time where U.S. government debt as a percentage of GDP got this high, right? So I think going forward, they're already talking about yield curve control, and they were talking about it even before the COVID crisis. Back in late 2019, they were already talking about yield curve control, and I think that's going to be a pretty common policy worldwide. As a base case, I'm expecting treasury yields to remain somewhat higher than their peers, but I think all of them are going to remain very low, and then over the long term, probably maintain below inflation rate.
Yeah, I'm pretty sure that's the goal. I don't think any central bank wants their yields to be rising.
Yeah.
Well, let's talk a little bit. We've touched on it a little bit, but let's get into the swap lines, because that's kind of been the primary tool through which the Fed has used over the last 3 or 4 months to ease the dollar squeeze, for lack of a better word, right? And I think right now the outstanding swap lines are around 350 billion. They got up to 450 billion at one point. The idea, my point with the swap lines, and then I've talked about this a lot, is that a number of people think that the swap lines are the tool, either the swap lines or Fed repo or reverse repo are the tools by which the Fed will bail out the rest of the world. And many people have said to me, there's no shortage of dollars, and if there is a shortage of dollars, the Fed will provide every dollar that is needed, and they will bail out the Eurodollar system and including the US dollar system. And the swap lines is the tool which they've used primarily so far. Can you talk to me about your view on the swap lines, and then let's go back and forth on that a little bit. I want to get your understanding, or I want to understand your view of the swap lines and the extent to which you think that they will use them, and to the extent to which you think they'll be successful in using them.
Sure. So if you look back, even back in 2008, right, which is the first time these tools really came out in earnest, we had the dollar spike during that period. Now, fortunately, at the time, it spiked from a pretty weak level, right? So it had a dollar peak earlier in the 2000s. It was in a more weaker trend at that point, but it had a sharp spike in relation to a similar effect that we saw in 2020 here. We had dollar shortage, we had a spike, we had a rise in the TED spread. And so what the Federal Reserve did is they opened swap lines with several peer central banks, major nations, and provided dollar liquidity in exchange for their currency as collateral. And what we saw is the TED spread went down pretty quickly. So the swap lines were effective in that. And then the dollar took several more months to work out before that finally went down, but at least it arrested it from continuing to go up. And it kind of put it in a range-bound state and eventually brought that down. We saw it again, since then a couple times. They briefly used some swap lines in 2012, but it was a much smaller event. And then in 2016, they had a dollar spike, but they didn't have to use swap lines. In 2020, their first tactic was to bring out the same swap lines they had back in 2008. So we had the TED spread spike, we had the dollar spike, so we opened the swap lines, but then we actually added more countries to the list. We more than doubled the list this time. So they included several major emerging markets. They excluded some of our more antagonistic, other countries, but for many friendly nations, they opened up all these swap lines. And so we've seen a leveling off, as you put it. We're below our maximum. We've seen a sharp decline in the TED spread again. and the dollar went down from its peak of 103. So yeah, I think the swap lines so far have been effective, but they don't, they're not meant to be permanent, right? But they can roll them as much as they want. So at the current time, I don't think the situation is necessarily over. I do think there's a decent probability that that spike we saw in March in the dollar might have been the top, but it's by no means guaranteed, because we have to see what happens later this year. If we have, a little bit more virus interactions in the economy, or if we see kind of disturbances around the election, or different effects on the swap lines. But currently, so far it's been effective.
Yeah, it certainly has. And I think one of the things I want to get across to listeners today, and Lyn, I know you know this because we've chatted about it a little bit, but I think it's really important in order to understand the big picture and to really understand my view, is to understand that there are two different dollar systems. There's the U.S. domestic dollar system, and there's the euro-dollar system. Now, for those that don't know, euro dollars are dollars that exist outside the United States. So that's not euros. Don't confuse it with the currency euros. It's just dollars that exist outside the United States. And the euro dollar market is arguably as big and potentially even bigger than the U.S. domestic market. The problem is that based on fractional reserve banking and money getting loaned into its existence, is when the flow of credit stops and reverses and goes the other way, that's typically when the central bank has to step in and be the lender of last resort and kind of plug this liquidity hole. The issue is that there is no entity outside the United States that has the jurisdiction or the authority to print dollars, for lack of a better word, and put new dollars into the system to recollateralize it. And I think that is the heart of it, because for those who say that the U.S. is going to have to continue to print to keep the U.S. dollar system going, I don't know who is going to print the euro for the euro dollar system to keep the euro dollar system going. And if you think we're going to have to print a couple trillion domestically, I can promise you we're going to have to print a couple more than a couple trillion internationally to plug that hole. And so, do you believe that the Fed will be able to provide 2, 3, 5, 6, 10, whatever the number is, trillion via swap lines to the international market? I mean, ultimately, do you think this will be successful?
I don't think they'll have to do that much, because if you look at the total amount of dollar-denominated debt in the world, right? So the BIS estimates that the U.S. going into this crisis had about $53 billion in debt here on our shores, U.S. dollar-denominated debt, which is easier for us to manage because, as you point out, we're the ones that get to print dollars. The foreign market, according to BIS, had about 12 trillion or 13 trillion in U.S. dollar-denominated debt. And of course, there's a couple other layers we can put on that if you want to, really look at the full size of it. But if we use that as like a kind of a baseline number, at least it's at least that big, if not larger. So they have even though it's a very large problem, it's a smaller, it's about a fifth of the size of the amount of dollar-denominated debt in the U.S. Going by that number, or a little more than about a fifth. So the magnitudes to address that are somewhat smaller. And I think an important thing to look at is whether it's a solvency crisis or a liquidity crisis, because for some countries, it's more of a solvency crisis, whereas for others, it's more of a liquidity crisis. And one way I look at it is by looking at how much dollar-denominated debt does that country have, either in their sovereign government or their corporations, compared to how much foreign exchange reserves they have, and how much overall kind of assets do they have, and particularly U.S. dollar-denominated assets. So if you look at the full scale, if there's 12 trillion in U.S. debt, dollar-denominated debt outside of the country, on the other side of that ledger, foreigners own about 40 trillion in U.S. assets, and that includes stocks, that includes corporate bonds, and that includes about 7 trillion in treasuries. And from what we saw in March and from what we saw in prior periods, they can sell those treasuries and sell those other assets in order to get dollars. So for many countries, it's not necessarily a solvency crisis because they have more assets in dollars than they have debts in dollars. But it creates a sharp liquidity problem if they have to sell those assets, both for themselves and for the U.S. Now, for some countries like Turkey, Chile, Argentina, Indonesia, Mexico, they have a lot of dollar-denominated debts, even relative to their foreign exchange reserves. So they face more of a solvency crisis where they don't necessarily have the dollar assets to sell. And that's when they have to really look at, are they going to have to default, or is the dollar going to weaken enough to give them more breathing room, right? So I think whether or not it's kind of a major crisis that we have to do trillions and trillions in swap lines to solve, I think it's kind of a useful approach to kind of look at it country by country and break down how does each country stand. And for the most part, if you look at Europe and Japan, The Credit Suisse, estimates that their net worth, total assets minus liabilities, is about $115 trillion. Now, most of that is denominated in euros and yen, right? So, and the BIS estimates that out of the 12 trillion in U.S. Debt, like dollar-denominated debt outside of the country, only about 4 trillion of that is in emerging markets, which leaves the other 8 trillion mostly in foreign developed markets. So, they have 115 trillion assets. They own a good chunk of that 40 trillion in dollar-denominated assets, and then they have about 8 trillion in dollar-denominated debts. Plus, if we're being more conservative, probably a couple other layers of dollar debt on top of that. So, in my view, it's for most countries, it's not a solvency crisis; it's a liquidity crisis. Whereas for especially smaller emerging markets and a couple of the larger emerging markets, it ventures into being a solvency crisis.
So do you think that these other countries will sell their U.S. dollar assets in order to pay off their U.S. dollar debts?
I don't think they're going to have to, because my base case is that the Fed will do what they can to prevent that from happening. So if the whole system unwinds in a very disorderly way, that's a potential outcome, and that harms both U.S. markets and foreign markets. But from what we've seen, they're probably going to do whatever they can to provide liquidity to prevent that sort of forced sell-off.
Okay, so let's pretend for a second, and I will acknowledge that you're possibly right. Maybe the Fed can provide enough liquidity in the short term to put off or delay the solvency issue. My question to you is, let's say that they don't. Let's take the hypothetical where the Fed doesn't provide the liquidity to the rest of the market. In what order do you think economies come under pressure? Do you think they all come down together, or do you think it's a knock-on effect of dominoes?
Well, I think the emerging markets, especially the ones that have, the ones I mentioned, the ones that have more dollar debt than FX reserves, they're the ones that are probably first to fall. And we actually saw this play out over the past couple of years. We saw Argentina crack, we saw Turkey crack, we started to see Chile crack. So in order roughly of how kind of insolvent they are is roughly the order they'd begin cracking in, with the U.S. and then some of the other majors that have far more assets than liabilities. They'd be the kind of last to have these issues. But risk assets, both especially U.S. dollar denominated ones, but really risk assets across the world would have sharp sell-off if they have to sell assets in order to raise dollars.
Okay, so I agree. So you agree, though, that we would have some kind of a progression. They wouldn't all come down together, and the U.S. wouldn't necessarily be the first to fall. I don't want to put words in your mouth. I just want to make sure I understand what your argument.
No, yeah, the U.S. would not be first. There are some emerging markets that would be, first in line.
And so if those emerging markets start to fall, do you think that there would be a contagion effect to where now the middle countries, the kind of the mid-market countries, for lack of a better word, would start to fall?
Yes, but at that point, we'd also have the treasury market most likely seizing up like we saw in March. So we'd very quickly have a lot of treasuries being basically put to the Fed. So the Fed would have to ramp up their QE unless they want to have the treasury market remain illiquid, which they can't do when they're also trying to issue a large number of treasuries to fund these fiscal programs and to make up for the tax shortfalls that they're having. So this would quickly become the Fed's problem again, because they would have to make sure that there's liquidity in the treasury market. Okay,
so I agree with you. It would be a challenge for the Treasury. Why wouldn't it become an issue for Canada's central bank? And why wouldn't it become an issue for England's central bank and Germany's central bank? Why would it only become an issue for the U.S. central bank?
Well, it'd be an issue for all of them, especially in order of how much kind of sovereign debt they have, because that's the first thing that they, as a sovereign monetary system, they can't let break, right? So right. Roughly in terms of debt. So the ones that have control of their own currency are somewhat more buffered. So the U.S., Canada, Japan. Now the big question is Europe, because many of them, they've linked their printing press together. So it would come down to how well they can coordinate. So for example, I also think there'd be pretty significant risk in Italy and Spain, for example. Yeah, but less so in Germany and things like that.
So if this happened, let's for the sake of assumption, this progression happened, right? The EM dominoes fall, and then some of the bigger countries fall, and it eventually works its way up to where the Fed and the ECB and the Bank of Japan are starting to get their rates are starting to rise. What do you think happens to the dollar in that environment? Is that an environment where the dollar would rise, or do you think the dollar would sell off there?
Oh, in that brief moment, yeah, we'd have what we saw in March. We'd have a pretty significant spike in the dollar, most likely, because that would be the key thing that's kind of causing all these risk assets to fall.
Okay. So then is it fair to say that because you think that the high might be in for the dollar, I think you said that April or the March high may have been the high in the dollar, and that because the Fed is kind of the rate of change with the Fed is quicker and faster and more powerful than the others, that's kind of led to the dollar selling off. Do you think that the Fed will continue to be the most aggressive and will be able to continue to, keep the dollar lower? Or do you think that we are going to have one of these re-escalations at some point?
So I think over the next several years, as a base case, that the Fed's probably going to be more aggressive in terms of balance sheet expansion than some of these other major countries. Yeah. And it's for a lot of reasons. Our country is very highly reliant on the services sector. For example, we have, more kind of wealth concentration. So our median citizen is somewhat less well off than the median citizen in Japan and Europe, even though our average wealth is in many cases higher. So our median is more vulnerable, and that's the people that have been the most impacted in this kind of environment that we're in. So we can kind of think of it as like a feedback loop. If they don't do enough fiscal, our country potentially risks as much or more civil unrest as some of these other countries because we have more people that are kind of just, they don't have any net worth and have lost income streams. So and we've also, for example, if you look back in 2019, the U.S. went into this with a larger deficit as a percentage of GDP than most other countries. So Germany came into this with a fiscal surplus. Even some of the more troubled European countries, they came in with 2% or 3% of GDP in deficits. So the U.S. actually went into this already kind of basically doing an MMT experiment where we were rising our deficits, even at the peak of an economic cycle, and just seeing how far we could go. So we went into this more structurally in a fiscal deficit. So as this plays out, I think there are going to be periods where the U.S. falls behind, because if we get so far ahead for, say, that like we did this quarter, we did so much more aggressive stimulus than a lot of the other countries. I think we could see a partial pullback where others catch up a little bit, but then I think the U.S. is going to continue to kind of pull forward.
So you touched on two things there, and I want to make sure I come back to it. But before we get completely off the swap line, I want to touch on one other thing. Let's go back to the scenario where we have if this doesn't if we don't have a reemergence of growth, and we do have to go back to extending swap lines in greater amounts, and we do get kind of this progression or falling of dominoes in an order. When these other countries, when we extend them liquidity via swap lines, right? The way it works is we give them dollars and they give us euros or yen or Brazilian reals or Australian, whatever it is, right? They post their currency. So where do since those countries are also under pressure and they're, feeling the deflationary pressures, where do they get the currency to pledge to the Fed?
Well, they print it.
Exactly. So if they print it, and they give us their currencies, how is it possible that we can print more than them if they have to print in order to get our dollars? If we have to print more to bail out the rest of the world, but they also have to print in order to get the dollars, how do we outprint them?
Because we'd be printing to support that, while also, in my view, probably printing more than them to support our own economy. And one way I look at it is that we have to look at the starting point for which currencies can we say are overvalued or undervalued, right? So, and there's a couple of different ways to do that. Some people prefer to look at charts, but fundamentally, I look at the balance of trade as kind of the key factor. So countries that have perpetually strong currency, the currency is, arguably overvalued, their import strength is very strong, whereas their export competitiveness is weak because their currency is so strong. So the U.S. for several decades now has had, because of our global reserve status, we've had very strong import power and our export competitiveness has declined. So our currency is propped up by reserve status and propped up by a dollar shortage. So we consume more than we produce. We've exported our supply chains effectively to the rest of the world, whereas countries like Japan, Europe's pretty balanced in this regard. Their currencies, despite problems, are not necessarily overvalued. They actually have closer to equilibrium between imports and exports. So in a situation where liquidity for all currencies becomes very abundant, ours is the one from the starting point that's held up by the dollar shortage. So if that dollar shortage gets relieved, like we saw back in 2017 to some extent, and like we saw, during the previous period of dollar weakness, around the global financial crisis time period, the dollar can fall relative to those other currencies just to get back to equilibrium, especially because now we have more of a political mandate to bring some of our supply chains home, which is very hard to do when you have a currency that's so strong that your exports are less competitive.
Well, but so you've just explained on the supply side, but I think, in my opinion, you're forgetting the demand side. Again, if you go back to those two systems, the euro-dollar market and the U.S. domestic market, there's a huge non-U.S. dollar market. There is not a huge non-U.S. euro market. There is not a huge non-Japan yen market. There's not a huge non-Brazil real market. And so if you think about the way the swap lines work, let's just say that Europe gives us $1 trillion of euros, and we give them $1 trillion of dollars. They don't take those dollars and go off and pay debt that already exists. They take that $1 trillion and they loan it out to make it $10 trillion in more dollar debt. So they're reinforcing the non-dollar system, or they're reinforcing and making bigger the euro-dollar system. So I don't see how, if they're reinforcing the system, how is the system ever going to change? How will we not just, maybe they can push this crisis down the road, but how do we not just end up back at this crisis again?
One way I look at it is that we're getting to the point where it's becoming more structural, right? So whenever the dollar gets strong, foreigners, because the dollar is so strong, they're not accumulating FX reserves anymore. That tends to, or at least not at the same pace. So in the $3 strong period we've had ever since the 1970s, whenever the dollar gets close to these, really high peaks, foreigners, they stop funding the treasury market essentially, or at least they sharply slow it down. So that happened back in the 1980s. That happened again in the early 2000s, and that happened again ever since 2015. So they stopped funding the U.S. Treasury, and then the federal government, the Federal Reserve and domestic institutions are forced to basically self-fund U.S. deficits. Right. So now we're moving into a period where debt is, we went into this year with 106% federal debt to GDP. Now it's already over 120% just because of all the COVID response. So now we're getting into a more structural period where if the dollar remains strong and if that cycle perpetuates, as you pointed out, then it's going to be very hard for the U.S. to rebuild the jobs that we lost, right? Because we've already exported most of our manufacturing chains. It's going to be very hard to bring them back in such a strong dollar environment. You're going to face civil unrest. You're going to face higher and higher, just political tensions, political polarization, which we've already been seeing. And we're going to have similar problems in the rest of the world too, especially starting in those emerging markets that are the most exposed. We already saw protests in many emerging markets, and then we saw it in France. So as long as that system continues to that level, we're going to see basically high unemployment and civil unrest. But the reason that the U.S. is potentially more impacted is because we're the ones that have essentially exported our supply chains, and we're heavily reliant on the services sector. And we have, left it so that our middle class is much harder for them to find employment in this environment because, we have less manufacturing, and the virus, fortunately or unfortunately, has impacted the service sector even more than the manufacturing sector, at least outside of certain very cyclical sectors. So the U.S. is going to find it increasingly difficult to get back to full employment if they don't weaken the dollar, which means, from my view, it's always useful to understand incentives, right? So when we talk about a dollar shortage, we're talking about a shortage in something that is not inherently scarce. They can print them as much as they want. They can distribute them as much as they want. And currencies all throughout the history devalue over time, and they can devalue at different rates. But in this current regime, as long as the dollar remains as strong, the U.S. is arguably more pressured, and all these countries are going to continue to have large trade surpluses with us.
Why would they continue to have a trade surplus if we go into a massive recession and we can't buy their goods anymore? Why are they still going to have a surplus? Why are their economies not going to come under pressure? Like if you think about who the biggest clients in the world are, China and the U.S. are the two biggest markets.
Yes.
Now, if we go into this massive recession and we can no longer buy these goods from other countries, how is that not going to impact those countries? How are their deficits not going to increase?
Oh, they will. but it becomes how quickly, right? So,
Okay, so
because they can still, to some extent, sell to each other, and because they make more goods, if
yeah,
they lose
but when they sell to each other, what do they invoice it in? What currency do they invoice it in?
dollars, usually.
Right, about 45% of global trade is invoiced
Yep.
in U.S. dollars. So if we get into it, let's say the central banks are able to push this problem off for another 5 years. Somehow they're able to delay it, right? Whatever happened in March, they're able to delay it happening again for 5 years. And over that 5 years, the U.S. has to fund their own deficits, and the Fed has to buy all the bonds or whatever, however you want to determine that. And over that same time period, we start extending swap lines to other countries because they have liquidity problems. And they take those swap lines and they extend dollar debt, because that's what a swap line does, is it extends dollar debt and it increases dollar debt. But over that same time period, those foreigners are no longer buying U.S. treasuries. What happens to the amount of their reserves versus their amount of U.S. debt?
It would increase.
Doesn't that it starts to increase, right? So I guess I can't figure out how we ever get out of this problem. I can figure out how we can delay it.
Yeah.
I just can't figure out how we don't eventually run up against it at some point again. It's kind of like 2008 and 9, we had this big crisis and they papered over it, but now here we are again. I can figure out lots of ways they can delay it. I just can't figure out how they can solve it. And I'm just curious if you have an idea in mind where they could actually solve this.
No, I think that's a great question. I think that's what a lot of us are kind of wondering, because I can see a range of possibilities, but there's so much variance for what they could do, from a very orderly way to a more disorderly way. So, for example, if we look back over history, the U.S. GDP used to be 30 or 40% of the total world GDP, but that's declined over time as the rest of the world, and especially the emerging world, has grown collectively faster than the U.S. So we now represent a much smaller percentage of world GDP. So back in the early days of the current dollar system, it made more sense because the U.S. was the largest importer of commodities, and we were by far the largest economy. But as the world has kind of outgrown us to some extent, right? The world is, we're still the largest individual economy, but we're no longer the largest commodity importer. And we're no longer as large of a share of the economy as we once were. So a simple solution, well, not simple because it's going to take a lot of time, is to do multiple currency oil pricing as a starter, and more broadly than that, multi-currency commodity pricing. And of course, there are other solutions down the road. They could do SDRs for global trade, but that requires a whole lot of coordination, which in this environment is very challenging. But the simpler solution is to basically see, a multipolar currency world rather than something that's so heavily focused on one currency. And, because people often ask, okay, if the dollar is not going to be the global reserve currency, who is? Who's going to take it from us, right? Is it going to be the euro? Is it going to be China? Like, of course not. But the answer, because even them, there's no longer one country large enough to supply the currency both for themselves and for the whole world to use. The whole world to be locked into all commodity pricing in one currency. So if they manage to delay it, that gives them more time to do multi-currency oil pricing. Europe could buy oil in euros, for example. It's possible we could see China or Japan being able to buy commodities in their currencies. And that's how you can begin to diversify global debts relative to global trade.
Okay, so you just touched on another part that I think is incredibly important, and that's the political part and the geopolitical part of currencies as well. There's the finance side, and there's the number side, and then there's the political side, right? Do you think that the U.S. wants to give up the global reserve currency? Do you think that the U.S. would stand by and quote unquote allow, for lack of a better word, Saudi Arabia to start selling a large percent of their oil to China in yuan or Europe in euros?
I think it depends on which portions of the U.S. So, for example, this current structure of having a very strong dollar, it does benefit a very select few, but then it harms a lot of the blue collar vote in particular, which, so that's why even Trump himself has wavered back and forth on whether or not he wants a weaker dollar or a stronger dollar. So I think at the current time, the U.S. is trying to have its cake and eat it too. It's trying to bring back supply chains. It wants to at least talk about bringing back supply chains and try to, bring some of those manufacturing jobs back. But at the same time, wants to have a global reserve currency, right? So doing both of those things is extraordinarily challenging. There's almost no way to see it happening. Maybe you have some ideas. I'd like to hear them about how they could do both.
Well, so yeah, I mean, I think we're getting back to this. We're talking about moving to a multipolar currency world, but we're also talking about the way we get there is we're extending dollar loans in the euro-dollar market to allow them time to do that.
Yeah.
But the extension of euro-dollar loans is diametrically opposed to moving to a multipolar currency world. If you take out dollar loans, you need dollar reserves in order to match your revenues with your liabilities. So, if we're extending dollar loans and the dollar system via swap lines, it's in direct contrast to moving towards a multipolar world. And I don't think, and so that's one issue. But the other issue is I don't think that the U.S. is ready to give up the world reserve currency. And I don't think world reserve currencies are ever, given up. I think they're always taken. Now, maybe it's done behind the curtain, so not everybody sees it. But there's tremendous advantages to having the global reserve currency. And I think it's a little bit of a misnomer to say that, a strong currency is bad for your economy. I think a strong currency is good for the blue collar workers. I think if you have a strong currency, your purchasing power is higher. I get into a little bit of a conundrum when I talk to some of my friends in the gold world who say, the U.S. can't survive with a strong dollar, but they also think we should move to a gold standard. Well, the gold standard is going to be a very strong dollar. That would lead to the dollar being very strong versus other currencies. So, I think that there's a way that, long story short, I don't think there's a way out of this mess. I don't think that there's a way out of the mess of the U.S. dollar debt, both the U.S. dollar debt and the euro dollar debt. I don't think that there's any way that we won't run up against this roadblock in the world again, because I don't think that the world will change behavior until they're forced to change behavior. And I don't think that the U.S. will willingly stand down as the global reserve currency. But I do think there is a way, and I'm probably not going to say this right, and I'm probably going to butcher this a little bit. But there's a guy named Varoufakis. I think is it Varoufakis, the Greek politician who wrote this about the Matador, where the U.S. would extend these dollar loans, and then 10 years later, they couldn't be paid back, so they'd go in and they'd harvest. These countries would go bankrupt, or these companies would go bankrupt, and then the U.S. would go in and negotiate preferable terms again. I think that the U.S. is going to use the dollar as a weapon over the next 4 or 5 years. I think it's going to end, and I should say, I think this is going to end extremely badly for the U.S. This is not a game where the U.S. ends up a winner. I just think that they are going to win longer than everybody else, if that's the right way to say it. I think that the swap lines will be used as a political tool. I think the swap lines will be used as a geopolitical negotiating carrot, for lack of a better word. And I think we will end up in this multipolar world. I do agree with you there. And I don't know if it'll be the U.S. versus China or U.S. versus Russia or how it'll actually come down. My guess is that it'll be China versus U.S. But I think countries around the world are going to have to decide. It's kind of going back to that George Bush line, which I hate, by the way. You're either with us or against us. And, I should also point out that I don't even really like my idea. I don't think this is the way it should be. I just think it's the way it's going to be. I don't think that the U.S. Is going to willingly stand down. I think that they are going to become, if people think that we've been a bully, I think we're going to become more of a bully. And I think we're going to use the dollar to our advantage. And I think until the rest of the world en masse says, screw you, for lack of a better word, as it relates to dollars, I don't see a way out of this mess. And I think on a relative basis, U.S. will do better than the rest of the world, because I do think we will try to bring some of these manufacturing businesses back to the United States, the strategically important industries back to the United States, industries that are, have national security implications back to the United States. And I think the Treasury will, or the combination of the MMT Treasury and the Fed will issue however much currencies necessary domestically to rebuild those industries. But I think we will deny the liquidity to the rest of the world if they're competing with us in those industries. And then this is why I think it all ends badly. I think in the short term, the U.S. outperforms the rest of the world, but I think it all ends badly because I just don't see a way out of this dollar mess. I mean, it's a trap of the biggest I mean, it's kind of, we talked about this one time about the singularity, right? All these different things are hitting. We've got this monetary crisis, we've got political crisis, we've got social crisis. And it's not just, it's definitely in the U.S., but it's all over the world. We've seen it a lot in Europe and the Middle East over the last couple of years. We're starting to see it in places like Hong Kong. So it's kind of a global thing.
Yeah, I think that's definitely a tail risk to consider, is the politicization of swap lines and, in general, access to the dollar, and while trying to forcibly bring our supply chains home. One thing I'd point out is that every time, the harvesting cycle, as you referred to it as, over that long term, the U.S., it's not like we reset fully each time. So over multiple decades, the U.S. net international investment position continues to deteriorate. And for viewers that don't know what that means, basically, a net international investment position measures how much assets does America own of foreign countries. How much do Americans own overseas versus how much American assets do foreigners own. So if you look back, after World War I, World War II, we were a creditor nation. So we owned more foreign assets than foreigners owned of our assets. And over time, especially starting in early 1970s, that began deteriorating because we kind of fixed the world to this dollar standard. It strengthened the dollar relative, it strengthened our import power, and it weakened our export competitiveness. So we started developing a more structural trade deficit. So we sent dollars overseas, we sent supply chains overseas. They reinvested those dollars into the treasury market, but also into our stock market, our housing market, our corporate bond market. So by 1985, we shifted to becoming a debtor nation. So foreigners owned more of our assets than we owned of their assets. And then by the 2008 crisis, our net international position was about negative 10% of our GDP. And in the past, 10, 12 years alone, that accelerated pretty dramatically. Now, the government currently estimates that our net international investment position is worse than negative 50% of GDP. So foreigners owned $40 trillion in U.S. assets, and we own $29 trillion in foreign assets for an $11 trillion net deficit, which is a little over half of our GDP. And I've seen some estimates that might decrease that a little bit, so it might only be negative 30%, negative 40%. There's somewhat of a range there, but the official government estimate is worse than negative 50%. And so over the long term, foreigners hold more and more of our assets and therefore have more and more leverage over us when it comes to how much they can damage our treasury market, how much they can damage our stock market if they're forced to sell those assets in order to get dollars. And that's why I view understanding the incentives of the U.S. Very important here, because if we try to politicize swap lines, which is possible, I think they're going to find out pretty quickly how damaging that is to us, because that's going to, foreigners have $40 trillion in basically leverage against us that they can use if we try to, sharply increase.
Let's say they do that for a second. Let's just take on. Let's take Chile for an example, right? Or let's take Mexico. If they sell all their, and they actually don't have a great dollar reserve versus dollar liability ratio, but let's just use any country. Let's say they sell 50% of their U.S. Treasuries or 75% of their U.S. Treasuries to pay off their dollar debt, and now they're left with little dollar reserves. How do they operate on the global stage when they no longer have dollars?
Well, most of them are still producing cash flows and getting dollars that way. So, for example, Japan has a trade surplus with us. Europe has a trade surplus with us. Even China has a trade surplus with us. So, I do, like I pointed out, there's some emerging markets that are just would. But
I guess my point is if they're selling all their dollar assets and they're pushing us into this major recession or depression as a result, their trade with us is going to collapse. Yeah. So how do they maintain this great trade balance if their number 2 or number 1 customer is no longer trading with them, or they've lost 50% of their trade?
This is why I think it's important to factor policy response into this, because as we saw earlier this year, once this starts happening, the response is so large, right? Because if they don't do that, we get a massive deflationary shock all throughout the world, the U.S., international markets, and basically it takes a lot of imagination to assume how restrained politicians would be in such an environment where risk assets are selling off, the treasury market's becoming illiquid, and then the Federal Reserve and the Treasury just stand by and say, okay, we have protests in the street.
Well, I think,
we have assets. Yeah.
I think we're in total agreement there. I just have trouble. I hear your answers, and the data that you cite is correct, because I mean I've gone and I've looked it up, and I just that kind of talks to me about what's happened the last 5 or 6 years. I think the next 5 or 6 years are going to be much different than the last 5 or 6 years, and so I'm trying to figure out how do all the positive things that the international community have continue for the next 5 or 6 years, even though everything's going to be bad for the U.S. for the next 5 or 6 years. Do you see what I'm saying? Like, a lot of people will say to me, look what the trade surpluses and the net investment positions, from, I don't know, 2014 or 2012, whatever the number is until now, the U.S. has gotten worse and the international community's gotten better. But now the U.S. all of a sudden for the next 5 years is going to go into a hole, and all these great things that happen to the international community is going to continue to do well. I can't get there. I just don't see how that happens. I cannot figure out how the U.S. goes into a massive recession and the rest of the world doesn't go with us.
No, I think if that happens, we all go into a massive recession as well. That's why my base case is that as soon as that begins forming, every month that we kind of go further and further into that hole, there's more and more policy response by the Treasury and the Federal Reserve to address that. And I think if we're thinking about tail risks that can happen, of like if they're just willing to shut those off and just kind of, play chicken with the rest of the world, and we have this big deflationary shock and we see what order we all break in, one is I think that takes a very large kind of almost like respect for politicians, how restrained they would have to be in that environment, which is not normally
crazy, right?
It's not normally a something I'd expect them to have. But two, we can imagine an opposite scenario. What if they do a tail risk in the other direction? What if they realize, how damaging that is, and they try to get ahead of it? So, for example, instead of politicizing swap lines, what if they make some of them permanent? So, for example, the Federal Reserve has done all sorts of things in this crisis that people, are still horrified by, like buying junk bond ETFs and buying individual corporate bonds and all sorts of things. Now, what if they, for example, the way that the liquidity swaps work is, we give them $1 loan, they give us currencies collateral. So if we move to say, if the U.S. realizes it's in its best interest to move to a more multipolar currency world, right? So most currencies have foreign exchange reserves. Now, for many countries, that's low, like maybe 5% of their GDP. And for other countries, that's very high. It can be 20%, 30%, 40%. And for some of them, it's over 100%, but that's rare. So if the U.S. Currently doesn't have almost any foreign exchange reserves, there's less than 1% of our GDP, because for the past several decades, we have not needed them. We are the axiom that the other ones hold. Right. So if the U.S. enters a more multipolar currency world, one thing that might want to do is establish some foreign exchange reserves. And one thing it could do is simply restructure the currency swaps to basically be a permanent swap. Like, we give you $1 trillion, you give us $1 trillion worth of euros, same for yen and a couple other major currencies. And the U.S. basically uses those to establish foreign exchange reserves, and they've, kind of sent out permanent dollars to the rest of the world. And I'm not saying that's going to happen. I'm saying if we're imagining kind of tail risk scenarios where we politicize swap lines, we also should imagine, kind of opposite scenarios of how this, if we're trying to imagine how could it unfold, how could it kind of be resolved. That's one of the options.
I agree with you. That I think it's highly unlikely, but I can't rule it out. And I think you're right. That would be one way. Again, I think that would be so to a certain extent the U.S. relinquishing all the advantages of the global reserve currency, which I think is, again, unlikely. But you're right. I can't rule it out. That would be potentially one way to do it. Well, let's talk. You brought up something there. You mentioned let's imagine these tail risk scenarios where they go the other way, and where they're, typically central banks and governments are reactive agencies. They're not proactive, right? They see the crisis, they react to it. It tides it over for a while till the next crisis, and they react to it again. But maybe they do get proactive, right? And one of the things that I find interesting right now is the cash that the Treasury has in their account at the Fed is the biggest it has ever been. It's like $1.5 trillion. Now, it ain't going to last because we have, these huge multi-trillion-dollar deficits. So it's definitely going to get spent. But what I find interesting is that I think part of the reason they had to extend the swap line is because they issued so many treasuries that the treasury sucked up all those, what is it? They sucked up like $1 trillion of dollar liquidity in the last 6 months or 9 months or something.
Yep.
And so now it's in their account. And if they had not extended the swap lines, I think the dollar would have shot up even higher, because that's typically what happens when the treasury issues debt. But now what I find interesting is that they've got more cash than they've ever had, but they are also scheduled to have like the biggest quarterly treasury issuance in history, I believe. I think Q3 they're supposed to issue another $1 or $2 trillion worth of debt. I don't have the right number right in front of me. But they've already, you see what I'm saying? Like, I'm trying to figure out what's going on here. I honestly, I don't have the answer. I don't know. Maybe they are proactively getting ready for a huge fiscal spend, in Q3 or Q4 or Q1 2021. Do you have any thoughts on that? 'Cause I honestly don't have the answer right now. I don't know. I'm trying to figure it out.
Yeah, I don't have the answer either, but I have looked it up. So, as you pointed out, it's over $1.5 trillion in the TGA, and historically, it's never really gone over 400 billion. And even that was pretty high. They started to have at higher levels so they could deal with like debt ceiling debates and things like that. They would have cash on hand. And their official target is, because if you look at Treasury press releases, they want to have it down to 800 billion by the end of the fiscal year.
In 2 weeks. No, I think by the end of the second quarter, right?
I thought it was the end of the final quarter, which for them is their fiscal year.
Maybe that's it.
Yeah.
Okay. Yeah.
Their fiscal year ends September 30th. So they want to have, but that's still 700 billion that they want to draw down. And so
crazy, right?
part of that could come from ongoing current fiscal programs. But I'm assuming that they want to draw that for kind of a late summer fiscal program. We've already had, the Trump administration supported another round of fiscal. The House Democrats, they passed that very large fiscal attempt that they know wouldn't get through the Senate, but they passed one. And then the Senate has already talked about kind of a smaller package. So I think, all the different, stakeholders have different views on what that fiscal is, but they seem to be in agreement that there's probably going to be another round of fiscal this year. So it's not a certainty, but it's definitely, I don't think either party wants to be the one to pull away the punch bowl because they know that they'll get blamed for it during the election. So I think they're kind of planning to have a lot of that liquidity for that next round of fiscal. But I do think they might find it challenging to get that down to their $800 billion target by the end of the fiscal year.
Okay, so let's say that they do that, and let's say they can just continue to pump out these treasuries, right? And to your point, the foreigners are no longer sterilizing it or whatever, so it's largely the U.S. domestic market and mainly the treasury. They go through a few steps, but essentially they're monetizing the debt, as is everyone else. So again, I don't think it's not a unique thing to the United States, but it is what it is. If they continue to issue treasuries at that rate, and Powell just continues to do QE at the rate that he's doing now, and he actually said, I don't know if it was yesterday or did he testify this morning?
Yes.
Well, the Fed meeting was last week, and then I think he testified. It was either today or yesterday, and he made the I'm going to paraphrase this, but he basically made the comment that if markets recover, then we would taper our bond purchases, and if they don't recover, then we'll continue. So I guess my point is if he doesn't, the fact that he even mentioned the word taper, I thought was kind of shocking because they've been just so dovish lately, right? But if they don't increase, but we have this massive increase of treasuries, it's kind of a net tightening, right?
Yeah.
In Q3. So I think they've got all this cash. I don't know. I think Q3 is going to be super interesting. I think it's going to be volatile. I don't know if it will be as volatile as Q1, but I think it's going to be much more volatile than Q2. Do you have any thoughts on that?
I view it the same way. So as we go later into the summer, at the end of July, some of those extra unemployment checks expire unless they're extended. So I think we're risking kind of potentially more civil unrest unless those are addressed. And then there's there's two main catalysts. One is if the Fed tries to taper, and if we get a lot of fiscal while the Fed's tapering, that's dollar bullish. That drains liquidity. On the other hand, if they try to taper fiscal and continue tapering monetary, then we get a potential deflationary crunch again, right? So we have kind of a loss of buying power. We get another deflationary crunch. That could be also dollar bullish. And on the other hand, if they do large fiscal and if the Fed accommodates by increasing their monetization rate again, so they suck up all of that extra issuance, and if the TGA account tries to draw down to get closer to their $800 billion fiscal year end target, we could see a big flush of liquidity. And I think that's kind of Trump's probably dream scenario, is to get a big flush of liquidity, in the late summer, early fall, right before the election.
And that's typically bad for the dollar. When that happens, that's typically the dollar. That dollar typically falls on that kind of a spend.
So I think we could see kind of a pinball, with the dollar going back and forth depending on which one of those things is happening at any given time. We could see, for example, a period of tightening, and then we could see a big flush of the account. So we could see kind of a dollar go up. We get more and more liquidity issues. We could see kind of a pullback in equities, and then we could get that big TGA flush to kind of prop up risk assets and devalue the dollar by a few percentage points going into the election. There's a couple different kind of variables, and it's important to watch out for the timing.
Okay, so we've talked a lot about the swap lines. We've talked a lot about Treasury issuance. We've talked a little bit about politics. Is there anything else that we haven't touched on that you think that we should focus on?
Sure. I guess I have a main question for you is if you were to kind of phrase the dollar milkshake theory today. So I won't put words in your mouth, but going back a few years when it was proposed, it was based on the idea that the U.S. was basically raising rates while most of the world was not. So we were monetary tightening. We were kind of doing very aggressive fiscal policy while also monetary tightening. We were kind of sucking up liquidity from the rest of the world. Now, starting in late 2019, when we started to cut rates, and then especially when we shifted to QE, I think the narrative for the dollar milkshake focused more on the foreign dollar-denominated debts, so the whole euro-dollar market. Is that how you'd kind of characterize that? That it kind of shifted to be more focused on the difficulty of unraveling that foreign dollar exposure, and is the kind of the tight monetary policy done? Like how would you phrase the dollar milkshake theory today?
As with everything, as events change, you need to kind of be ready to adapt and change along with them. I don't think the milkshake theory has changed all that much, although the primary focus has left from interest rates to other aspects. So, the dollar milkshake theory basically says the U.S. has a straw that we're going to suck up the liquidity from the rest of the world. Now, the primary driver or the primary characteristic of that straw 2 or 3 years ago was higher interest rates. And the fact that they weren't just higher, but we were raising them. And that was far and away the most bullish aspect of my strong dollar thesis. But it was never the only aspect of the strong dollar thesis. It was the predominant one, and it was the easiest one to point out and the easiest one to look at and say, hey, this is a big advantage. But it was never the only one. The other parts of the straw include the deepest global markets in the world. The biggest consumer economy. We're the number one or number two client for everybody else in the world. The dollar payment system over which capital flows around the world is literally controlled by the United States, and the fact that we can kick people out of it if we don't want to. The rule of law. Now, I know a lot of people laugh at me when I say the rule of law in the United States because some people think it doesn't exist. And I won't argue that point too much other than to say, show me another country where it exists more. Again, all this stuff is relative. Also, the fact that we are the global superpower. Again, I don't necessarily like it. I don't really like our foreign policy, but it is what it is. And we enforced our dollar hegemony around the world. We control the sea lanes. The U.S. Navy is a big part of the U.S. dollar being the global reserve currency, whether you like it or not. And then also the global denominated debt, and the fact that debt, until the whole system blows up, debt is demand for the currency in which it is issued. And until the rest of the world can find another currency or another system which they're willing to leave and go to en masse, that dollar debt is demand for the dollar. And I think all of those things combined create much more demand for the dollar than there is for any other currency. And, this extension of the swap lines, it not only forces the United States to print, but it forces other currencies to print as well, because the only way they get dollars is by pledging their own currency. But if you have a system where both sides are printing and there's demand for one currency and not demand for the other currency, then I think that's how you get hyperinflation or high levels of inflation. But it's not in the dollar; it's in those other currencies that are having to be printed in order to get a currency in demand, and they're printing a currency that has little demand, especially outside their own borders. And so, as that happens, then I think the dollar goes higher on a relative basis. Now, it might lose in real terms versus gold or some other real assets. But that's to your initial question. Interest rates are still higher in the U.S. than the other major countries around the world. So on a relative basis, they are still higher. So it's still a factor. It's not as big a factor as it used to be. But I should also point out that it was the other reason that it was never the interest rates were never the only factor was because I've always been of the belief that we're going to get into a situation where there will be such demand for the U.S. dollar that the U.S. Treasury will revert to being the lowest yielding sovereign, because other yields around the world will start to rise, not because things are getting better and they're growing, but because of counterparty risk, and people will want to get paid more to own these foreign sovereigns. So the idea that the U.S. has to have the highest yielding currency in order for the milkshake to work has never been the case. It was always the initial factor, but it was never the entire argument.
Makes sense. And I think probably a decent way to wrap up to make it actionable for viewers is to kind of say, roughly speaking, if your thesis plays out, how do you think investors can best position for it? And then I'll say, from my perspective, if my view kind of plays out like my base case, and the dollar continues to be range bound or eventually goes down, we have the U.S. basically forced to provide liquidity. If we have that kind of that sort of play out over the next several years. So in my view, I'm bullish on precious metals. I'm recently more bullish on Bitcoin. I'm pretty bullish on global equities and in the U.S. market, some of the more industrial equities, some of the more like high quality cyclicals. And I use treasuries in a somewhat counter-cyclical way. So when we have kind of more froth and risk assets, I take some chips off the table. When we have kind of a sell-off, I put some chips back on the table. And that's been my approach. And so I structure a portfolio in a way that kind of benefits from all currencies devaluing versus gold and versus other kind of hard assets, but that can withstand kind of a dollar spike like we saw in March without kind of permanent capital destruction. So how would you say that you're positioned, if your thesis plays out?
Thank you for asking that question. Because I think it's important to kind of understand this. So I actually I have two different portfolios. I have a long only portfolio where I manage money for clients and separately managed accounts, and then I have a fund that's specifically designed to play the milkshake theory. In the separately managed accounts, we're largely trying to protect against a lot of the stuff that we see coming down the pike because we think it's for the most part negative for risk assets. And in the fund, we're actually trying to profit from the chaos that we see coming. And so I think as an overall, pie is how I have, allocating clients. And again, I customize everything to everybody. So all of my clients have different allocations based on their personal needs and wants and stuff. But in general, I think people will understand that, I'm positive on US dollar assets versus the rest of the world. Now, in the short term, I do think that we're going to have another rise in the dollar. I think that will initially be bad for US dollar assets, or at least equities. So I think we'll get another downdraft in equities. The rise that we've seen in equities over the last 2 or 3 months is not the milkshake. This is not the milkshake theory as I foresee it in the heart of it. This is largely a liquidity-driven rally by all the central banks mixed in the milkshake, where I think that the dollar and the dollar's been falling during this rally of equities. As we get further into the crisis, that's when I think equities will come down, between now and the election, let's say, or early next year. But then as we get further into the crisis, and I think people will flock to the dollar for a number of the reasons that we've talked about, I think that will push U.S. asset prices higher. And I think you should also have an allocation to gold. I've always said everybody should have an allocation to gold. We will get into a situation where dollars and gold are maybe the two most important assets that you can own. And as other currencies fall away and, people around the world look for safe havens, I think the dollars and gold will be the two of the most important assets they will go to. I do think that we'll get into a situation where foreigners, if they those foreigners and those foreign institutions that have capital to invest who haven't had to sell their US dollar assets in order to fund their US dollar liabilities will increasingly look at the United States as a place, as a relative safe haven. Now, it doesn't mean that it's great, but I think if I'm a Brazilian manager and I can buy Coca-Cola and it pays me 3% a year and the Brazilian real goes down 10% a year and Coca-Cola goes up 5% a year, I've just made a high, double-digit return or in the teens. And that's not too bad if I'm sitting in Sao Paulo, looking at the Brazilian market. I think we'll see that, on a relatively large basis. And I think that will push U.S. asset prices higher than people think possible over the next couple of years. I think we're going to have a full-scale currency crisis. I don't think that the swap lines will solve anything other than make the problem bigger. And I think we'll eventually hit it. And I think when that happens, it's going to be really bad for the world. And I don't like being a negative person. And I would actually be fine if I turn out to be wrong. I can't figure out a way out of this trap. So anyway, that's kind of how. So long story short, I would have gold, some short-term treasuries, maybe even medium-term treasuries. I would, if you have equities now, I'd have them hedged. And, if we get another sell-off, then I would be an aggressive buyer of U.S. equities. Makes
sense. Yeah, it's great talk, I think.
Yeah. Well, I think, I think as wrapping this up, I think you and I largely see a lot of the same issues. We've identified a lot of the same issues. I think it largely comes down to whether or not the central banks are able to handle the problems and if they're clever enough or smart enough or creative enough in order to come up with ways to keep it all from unraveling. And I think perhaps I'm a little bit less skeptical or more skeptical than you are. But maybe that's not the right way to say it. But again, I think we've identified a lot of the same issues. It's just a matter of, which way. And this is one of the amazing things to me is, I appreciate all the conversations we've had on Twitter. I appreciate this conversation today. It's always amazing to me that people can look at the exact same information and come to two dramatically different conclusions. But, that's ultimately what makes a market. And, I really appreciate your willingness to come on and, talk about this stuff. And not everybody can disagree with a smile on their face. Some people have a hard time, but you seem to be able to do it. And I hope whenever we interact, you don't take my disagreements as anything personal.
Yeah, same for me. I've always enjoyed our interactions. And, I think a lot of people take things too personally. And I think that's actually when people get into trouble is when they start kind of tying their ego to their investment positions rather than just constantly like looking at it objectively and saying, okay, what's changing? What's happening now? Is my thesis still intact? Do I have to shift it? And I think that's kind of what makes for, kind of good investment outcomes is just always being willing to adapt as new information comes.
Yeah, and it's amazing how long these big macro themes take to play out. So, like you said, we've talked, the dollar's been going sideways for the most part for 5 years. Gold, gold was down for 6 years. Now it's back up. People have been talking about Japan's going to go into hyperinflation and the yen's going to, but it's still where it was. And it takes a long time for this stuff to play out. So anyway, well, it's great talking to you. I'm sure we'll be talking again. And hopefully the Real Vision listeners have enjoyed this and have gotten some good value out of it.
Yeah. Thanks for the chat.
If you're ready to go beyond the interview, make sure you visit realvision.com where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.